Pavitra, hi, good to have you with us. How have you been?
Hey, I'm doing great, Ashu. Thank you for having me.
This is a conversation that I've been looking forward to, and this dialogue has become a little cliched, right? I'll end up saying this, before every conversation that I have. But the fact of the matter is, I've had some amazing people to come in and join us for these conversations, and I think we've been able to understand and bring out a narrative in a very different way, right? So I think I'm left with no other choice but to sort of start it on an exciting note where I am excited about the conversation, right? And I think this one is special, right? With all the good work that you've been doing, right? And I think fintech. Uh, the role that it's played in helping consumers go out and consumer businesses become efficient, right? With so much of data, digital option, I think we've been through a very, very interesting time, right? It couldn't have been better to have you around now, right? And discussing this, right? Because you as a player are plugged into pretty much every single ecosystem when it comes to lending, right? And have a very thick and a strong technology layer, which empowers a lot of these institutions to very quickly, on the fly, offer credit to their consumers, right, or a captive audience base that they have, right? That's it becomes an exciting conversation, interesting conversation in that sense.
Yeah, right. You're right. I think that, Ashu, like, I know that you had your own entrepreneurial journey back in the day, and I think it would have been better if somebody like us also existed, right, to act as like a backbone and an infrastructure layer so that you
Right,
could ride off. I think that friction is what we're eliminating because a player such as us exists, right?
right,
And what we essentially are is an infrastructure layer NBFC that allows any company or fintech or tech marketplace to launch a credit product to its own set of customers,
right,
right? I mean, the old way of lending is traditionally centralized, and what I mean by that is like you would have to get your own license, you would have your own LMS, you'd have to go
right,
manage your own banking relationships, then you would have your own operations team, then you would have a credit team, then you have a sales team that's set up in a physical branch that would go meet the customer, and then you
right,
would source the customer, then you would also have collections. So like this whole value system is what led to like a lot of like regional players, right? If you look at
right,
traditionally, lenders are regional in scale, like especially apart from like say Bajaj Finance, which is a large NBFC,
right,
most players are regional in nature. Like you would have
right,
some player in South, you would have some player in Gujarat, and you would have
right.
some player in Rajasthan. So what we did is
But before we do that, right? Sorry for interjecting, right? I'd love you to, a quick round of introduction is going to be helpful, right? And then we dive into the session for the day, right? And we're going to cover all of what you kind of highlighted, right? And we'd sort of, definitely, request you to take us through the journey of building Kudos, right? But a quick round of introduction is going to be helpful. A little bit about yourself, and then we dive into the session today.
okay, yeah, sorry about that. Just like
That's all right.
excited to share the story, man. Hey, so Ashu, thanks for having me, right? First of all, like just a little bit about me. I was in US for 6 years between 2001 and 2007.
Right.
Like a lot of players, a lot of people back in that generation, I figured that I was there. I graduated with a degree in finance and working for Wells Fargo.
Hmm.
But the all I could read about at that time was the India and China story. So
Right.
and one time I saw Rang De Basanti and I was super motivated to come
Right.
back and try to do something for and contribute to India. Of course, while when I did come back to actually set up an online education company,
Right.
that didn't work out. It failed spectacularly. So
Right.
and the reality of getting things done in India was supremely challenging in terms of adjusting and just the way uh, things are over here, right? When
Right.
you compare to comparatively when you are how things are in the US. However, like I just knew that doing a job wasn't meant for me. There was
Right.
something in me that was I felt that I was existing, not living. So and India
Right.
will give you enough opportunities to live. All the challenges will keep you
Right.
going alive. So when I came back here, I think in 2009, just out of like a very simple premise that,
Mhm.
hey, look, credit seems going to be a huge demand,
Right.
right? It was still nascent in India. There's a huge credit demand that still needed to be fulfilled.
Right.
So just from that simple premise, I applied for an NBFC license and we got it in 2010.
Right.
But really the operations only started in 2014. Until 2014, I use that time to just kind of explore India, travel a bit, learn
Right.
a lot more about myself. And in 2014, we actually took a crack at it and started the
Right.
NBFC
Interesting.
full time. Yeah.
Super. Although I'd love to, so you have transitioned from being a traditional NBFC, right, a player in that category, to being a fintech infrastructure company, right? I mean, tell me a little more about that transition, right? How did that happen? What we've seen the last about 3 years, 2.5, 3 years, right, has been absolutely phenomenal, right? I think we possibly needed the technology layer for the entire credit market to kind of take off, right? I mean, otherwise, in a typical traditional environment, even 2014, 15, 16, right, it used to be a very archaic process, right, which took forever for the money for one to sort of send out an application. There was this huge physical infrastructure which was required to sort of do that. But that all changed 17, 18 onwards, right? We've seen a huge surge, right, of these fintech companies coming in. There are models that are coming up, partnerships of a very different kind that are sort of coming together, and the channelization of money has become so much more faster, right? Velocity of capital,
Yeah.
as we discussed, right, which is theoretically also covered across many journals, white papers, right? I think we are essentially in that phase, right? Tell us a little more about that. And second part of the question: what do you make out of where we are as an economy, right? I'd love to understand that.
Sure. Yeah. I mean, there's so much has changed in the last, like, from when we started until
Right.
now, and then the pace of change is like incredible.
Mm-hmm.
And there's no better time than now. But to
Right.
give you context as to where we started in 2014 was a completely brick and mortar led NBFC, right? We
Right.
were more trying to cater to the MSME segment, the missing middle, as you would call it, right?
Right.
The neighborhood retailer store, the neighborhood kirana store, the garage, the stationery store. And then the way we would do it is that I had like a sales team, and the traditional way of lending is that we would own the whole piece. We would go
Right.
find the customer, the operation, sales, and you
Right.
would have credit and collections all in house. Everything was done physically. And that model, what the way a typical loan would go is that we would go meet the customer physically at his
Right.
store and understand what that business is. We'd collect the documents physically, come
Right.
back into our office, and then one by one fill in his ITR record, into the system, and then take the
Right.
bank statement, evaluate that, and then create like a PD sheet, right? Do you remember those? Like a
I
PD
do.
report.
Right.
And then you would go and meet the customer physically, and then you would cross verify all the information. And then it had a level of subjectivity, right? Like,
Right.
despite you having those documents, because it's a lot of like cash business,
Right.
the ITR record would say like it's 30 lakh rupee revenue, but really the guy had revenue of maybe it's 80 lakhs or maybe it's 10 lakhs.
Right.
You really can't tell.
Right.
But you had to do that process, and you would learn each business and its nuance about how margins in those segments move.
Right.
And once you do the personal discussion, it would still take roughly around a week,
Right.
to disperse the money. Then the
Uh-huh.
collections was done, like, the repayments were done by checks. You would deposit the checks into the account on the set date. And if the collection ever failed, you would have to go physically go collect that cash.
Right.
That is the world that KUDOS was born out of, and in that model, we from 2014 to roughly around 2018, we did a one branch NBFC that had no lenders.
Right.
Went on to do 100 crores worth of disbursement in that
Interesting.
model,
Right.
right? We built, we got 11 lenders on board to lend to us, right? Which is include some banks and NBFCs.
Right.
We had 3 branches in Pune and 1 in Nasik, and we had like roughly around a 55-member team.
Right.
And yet, despite all of that, like we would do roughly around 3 crores worth of disbursement per month. So from a brick and mortar standpoint, like, not bad, right?
Right.
Not bad outcome. However, like, it was never the dream that I came here for.
Right.
It sounded like, hey, we went through all this effort and it's just not scalable. It's so
Right.
people oriented, that process. So a couple of events happened, right? That led us to where we are today, actually. And then some were beyond your control, which is obviously all the digitization that we've constantly been on, right? And this path really started from 2016 when the whole demon event happened. It led to digitization and UPI payments and less cash.
Right.
But in 2017, the event that led to our change in our model was that I got reached out on LinkedIn by one of the founders of a fintech called Bonfleet.
Mhm.
All right.
Right.
And it was a very cool idea to say, hey, listen, I'm a founder of a fintech and I've gotten tied up with Uber, right?
Right.
And with Uber, I have managed to give them a card, an expense management card
Interesting.
for its drivers for petrol consumption,
Right.
right? And I need an NBFC to support me, right? Like to be my credit partner for this card.
Right.
So the thing was that the card was supposed to be used by Uber drivers only for fuel consumption.
Right.
The premise being that if he has more fuel, he drives more. If he drives more, he earns more. And Uber would deduct the fuel charges and
Right.
then pay the driver, right?
Right.
So I was like, wait a minute, this is a end use control because you can only use it for fuel,
Right.
and B, that is cash flow trap. I'm like, this sounds phenomenal. So we
Right.
did that partnership,
Mhm.
and then we realized that, wait a minute, this is a way more powerful distribution method and
Right.
way more scalable.
Right.
So from that one, we went from 2014 to 2018, there are 100 crores of the disbursement with all these three physical branches and 55 team members. To 2018 onwards, doing only partnership-led model, no
Right.
more direct lending.
Right.
And we did 2,500 crores worth of disbursement.
Wow.
We did over 2 million loans, right? We have customers in over 2,100 cities. We have one physical branch and a 44-member team. So,
That's phenomenal.
yeah. And then, so it kind of, we just like got onto that train of,
Right.
digitization, and it's just the right moment of all these fintechs flourishing and then needing an infrastructure layer NBFC, such
Right.
as KUDOS. So what we are today is that we allow any tech marketplace of fintech to launch its own credit product to its
Right.
own set of customers.
Mhm.
They can focus on product innovation and distribution, and we just take care of the whole backend, which is the regulation, compliance, technology stack, capital. We'll bring all of that for them.
Very interesting. Very
Yeah.
interesting. Pavitra, in an environment like this, right? You've actually kind of, you kind of walked me into my next question, right? Which is essentially about understanding, what are the core products that you offer. And so I'd love you to give me a breakdown in terms of, so of course, there's one problem that you're solving with capital, and the second problem that you're solving is that of the tech infrastructure, which is required, right? And third possibly becomes, the legal and compliance layer, right? For whatever clients and customers that these people have, they can immediately plug this, right? What I want to understand is, of course, I want to understand a little more about the three pieces, right? The three buckets that you have. But what I also want to understand is how does the credit piece happen, right? Now, if I am, for example, a business, right, which has say 100,000, uh, people, right, and there could be business providers, there could be consumers, right, who I want to offer credit. Now, do I need to, as a company, as a player, define my own credit stack, or is there a role that you play, saying that, listen, you don't know about credit, right? We have the mechanics to understand these customers better. We will step in, we will understand it better. You take care of what you're doing, you improve your transactional possibilities, whatever, right? The environment for them to trade better, faster, right? And we'll take care of the rest, right? Is that a fair understanding, or there
Yeah.
is a certain expectation from me as a business provider that you have in the process? I'm asking about a typical relationship that you would have, right? And the onus on me when I get into this relationship.
So like essentially what we're allowing you is to just focus on product innovation distribution. So you
Right.
would, let's say, for example, you're in education finance and you want to finance the child's compulsory education, right? The school fees. So if you would come to us with a credit program, that these are the customer segments that I'm going after. This is the typical profile of the customer, whether that be the income band, that could be the bureau band, that could be like, the age band. And then we would co-create that credit policy. See, from our vantage point, you are probably the fifth or the fourth, education fintech, or the third gig economy fintech, or the fifth revenue-based financing fintech, right? And all innovation is incremental in terms of that form factor. So we would co-create the credit policy, since we have a better understanding as to what works and what doesn't work, right? And we would provide that input, and we would freeze on that credit policy. And now only once those customers that we have agreed on that, hey, these are the customers that will be actually sit on our balance sheet, and these are the customers that we lend to, are the fintech's responsibility to actually find, empower those customers, right? Give them a credit product and improve distribution on that front. So that's on your credit question, right? Like how does that work? Your responsibility is that you would bring a credit policy, we would tweak it, and then your responsibility is to do all the interfacing with the customer. Now, your interface could be an app, your interface could be a website, your interface could be, could be like at a physical store, in a hospital for healthcare financing. So you focus on that, but all the backend that is required now, you got everything at a one-stop shop, right? Can you imagine right now, if you wanted to go actually start a fintech, your typical journey is to go convince a bank to give you a line of credit. That itself is a bureaucratic process. You have to engage with multiple vendors to actually give out a loan, right? So on the one hand, what we solve for is capital because we become a one-stop. We are an NBFC, right? Two, we help you co-create the credit policy. Three is that to actually give a loan, a whole bunch of services need to be connected, right? For you to actually give that loan. And that those services, as you well know, you would want to evaluate, let's say, the bureau of the customer. You would want to do eKYC. You need to validate the PAN. You need to validate Aadhaar card. You want to give a form factor of a card. Is it an EMI loan? Is it a credit card loan? Do you want to disperse the money through payment gateways, right? So we bring all of that, literally all of the solutions. You want to launch an insurance product on top of your lending product. You want to collect on these. We become a one-stop shop. You simply plug into our infrastructure. And on a menu-driven, the FinTech can choose multiple of the microservices. So that becomes a technology layer, right? So a technology layer, and then you have capital, and then all of this sitting underpinned by our technology stack and infrastructure. So you leverage all of this when you come work with KUDOS. You simply focus on your core competence.
Interesting.
And your core competence is understanding which is the customer you want to cater to,
right
product that you want to give, and the interfacing with the customer.
Interesting.
Right? So that's how we essentially we're removing the friction for lending.
Right.
The friction.
No, I think you're making some, a lot of people's life easy, right? I mean, I was in a conversation with, a founder recently, right? And I think through the course of the conversation, what we discovered was, we were actually talking about fintech and the possibilities are on fintech, right? The cross-sell basically, right? And I think through the course of the process, right? Somebody very famously said that eventually every company is going to be a fintech company, right? And his point of view was that, listen, this is easier said than done, right? It's just so much more distributed. It's very difficult for me to go out and aggregate everybody and start this business, right? And here you are, right? We talk about having everything under one roof, right? And it's a very plug and play sort of a solution which could be delivered much faster without necessarily any hassle, right? And I think that just makes the entire proposition very, very interesting. Pavitra, I would want to move to slightly more, deeper questions, right? Which are more around, the underwriting play, right? And especially post-COVID, how that has changed and stuff, right? But before I do that, right, I'd love to understand, what's the sector split, right? So on the book that you have right now, how is that book split, right? How much of it is exposed to which sector? And, are these basically asset-backed loans? Are they smaller loans, right? What's the portfolio like right now?
So I just want to address that the real pain point. Think about it this way, right? Currently, we power 27 tech marketplaces and fintechs, right? For lending, correct? Now, if we didn't exist, this is the pathway for them to actually become a lender. Either they could go become an NBFC themselves, which means I go put a deposit, wait for a year, get your LMS in place, get your liability in place, and then launch off, right? But because somebody like us exists, the speed of financial innovation that we drive through because of us is phenomenal, right? Like now 27 fintechs are solving various use cases across segments. That could be, and the segments that we are catering to right now, and this keeps innovating. Every time we see the pipeline, it's like, oh, that's an interesting form factor. So I'll give you an example, right? Like the usual suspects are education finance, agriculture finance. We do revenue-based financing, startup card financing, and gig economy financing. But there are various multiple use cases that I did that just I'm like, wow. And what I mean by that is so for content creators, right? There's actually a fintech right now that's actually going to pull your, build an underwriting model on content creation. Right. And how are you going to do that? You're going to actually pull how many YouTube subscribers do you have? How many Instagram followers do you have? If you're a coder, then I'm going to check your GitHub. So the amount of innovation that's happening in fintech. So these are our 5 segments right now, but I can't say these will always be it. But despite it appearing to be so many segments, they essentially they all go through a very simple 5-point framework. Right. Although education finance, agriculture finance, education, all of these segments have its own nuance, but they will all go through this 5-point framework that we've developed. A, it needs to be API led. Okay. 2, it needs to be short in tenure, and we define tenure as little as 15 days up to a year at the most.
Very interesting.
3, it needs to be small in ticket size, and the ticket size could be as little as 1,000 up to a few lakhs. Right. 4, it needs to be end use controlled.
Right.
Okay. Like I was telling you at the beginning of the example, like
Interesting.
the money doesn't go to the end customer, it goes to the intent it was borrowed for. So in
Right.
education finance, the money would go to the school, wouldn't go to the parent, and you would hope that he uses the money for education. And 5 is that it needs to be cash flow trapped.
Mhm.
So if the money is given to the end customer, then
Right.
you need to have some sort, either his income the EMI is deducted from source,
Right.
right? So because of this 5-point framework,
Mm-hmm.
it's short in tenure. Despite COVID happening, our portfolio has held up, and COVID has been like a stress test, right?
Right.
Average tenure is about 70 to 80 days. So the quick turnaround time allows us to either understand whether to scale this, lending, or to
Right.
scale down on it.
Interesting.
So despite all of that, we've been profitable ever since our journey, and even COVID, we never took any pay cuts, we never took any
Right.
morats, and we were profitable even in that journey,
Interesting.
even during that time.
Pavitra, I love how you kind of, how you took us through this entire, the question that I had for you, right? COVID is not an event that I think any of us anticipated, right? It's just been a very unreal event, right? It's hit us in a very, different way, and it created a lot of difficulties, right? Business got disrupted, right? Everything literally came to a standstill. Now, what had happened was a lot of NBFCs went through a huge pain, right? But what it's possibly done, right? It's moved audience to a digital environment, which is more predictable, right? But it's also made it very difficult, where businesses will not necessarily have a very clear picture in terms of what's going to be the longevity of association with a consumer, right? Today, for example, kids, right? They're buying of content on YouTube, right? And that preference is changing, and how, right? With that speed, do you think the models that have been designed, right, and what we've experienced in terms of underwriting, right, will survive what we are about to enter? Because this is going to be extremely unpredictable, right? Unless businesses align a lot of other parts, right? And this is more to do with business side lending. Parts of it, of course, touch upon consumer side lending as well. It's going to be a very difficult environment, right? Which eventually will have a certain effect on the overall profitability and P&L of lenders, right? What do you make out of this particular thing, right? Are the models prepared? Do we need to have better evolved models which factor in more nuances, before we go out and make those, deployments? What's your sense of it? How do you comprehend the situation?
That's a very interesting point, right? And question. And but the observation and the hypothesis that we're holding up is that, see, I think there are two types of lenders. One is who try to build a book, right? Who's like, hey, listen, I'm going to give out a loan for 3 years, and I want to give out loans for 5 years or 7 years or 10 years, and I want to
Right.
do asset backed, and I want to do it on traditional underwriting, whether I take his income tax, I take his GST return, I
Right.
take his bank statement, then I'm going to give you a 25 lakh rupee loan,
Sure.
and I hope that your business continues to scale, and that I'm going to get my EMI back on the fifth.
Right.
We're not in that world. So,
Right.
we
Yeah.
don't believe in that world either, because like you said, if COVID taught you anything, the pace of change is so phenomenal
Right.
that I cannot reasonably predict your life or my life, what is going to be 18 months or 24 months from now, or what
Right.
is even relevant. So like with that hypothesis or just framework of how the world is working, our worldview is that it needs to be short in tenure,
Mhm.
right? The short in tenure is like the absolute holy grail for us. Like if
Right.
anybody comes to us and say, listen, I want to launch an 18-month or 24-month, it's an easy
Right.
no, right? It doesn't matter even if it's like a very compelling, safe product that will generate IRR.
Right.
Just the fact that COVID can like come in, or any external event can come in and completely disrupt the status quo.
Right.
It leaves us with a point of view that the old way of doing lending is done.
Right.
Right? There will always be players that will kind of like play that game, and they'll do really well. But
Right.
like you rightly pointed out, there is a lot of pain on the streets, especially for traditional lenders, right? Who relied on physical interaction, who relied that the lockdowns didn't happen.
Right.
Those businesses are never coming back.
Mhm.
If you're an MSME business,
Right.
a 30,000 rupee outflow
Mhm.
is life changing for
Right.
you. Like for you and me, probably not. But if you've taken a 3 lakh rupee loan and your EMI is like 10,000, and now you're at a 30,000 rupee outflow, unexpected, it's going to throw it off. So
Right.
all those NBFCs will struggle,
Mhm.
the traditional lenders, right? What we're offering, so that's my take on that, right? And I
Sure.
think it's playing out as we speak. So COVID had like a K-shaped recovery. On the one hand, like you rightly pointed out, there were winners in this. The winners were everybody who were already technology ready,
Right.
right? And the losers were who relied that, hey, listen, the way it was, the way it's going to be.
Right.
So we were already we internalized this conversation a lot of times, saying that we built for a world that doesn't exist yet. When COVID, but when COVID came, the rush of number of fintech customers, the adoption, all our microservices that we have just went through the roof. Right. And like I said, because it's short in tenure, end use controlled, or it's cash flow trap, our portfolios performed far superior.
Right.
So we never took a hit at that. So and this trend is for here to stay, right? Like everything is on demand from your credit is also going to be on demand and like short in tenure. That's the hypothesis that we're building. That's why, despite it being such a small company with only a 44-member team, we've done 2,500 crores worth of disbursement, and we're powering over 25 fintechs. And the worldview that we're holding is that apart from fintechs, like you rightly said, that a lot of these companies, somebody famous did say that, I think it was Anderson, right, from A16 said that every company in the future will be fintech. That is happening. It's happening at like maybe like all things, they start off slow, but they come to a S-curve adoption rate, right, where they just kind of explode. And I feel like we are like when the baby steps are, you can see them, right? Like look at cred, right? Cred doing that, you are attracting all these customers that you can lend to. Look at Bharat Pay, right? Now it access saving and lending to these customers. Or you could look at any payment gateway. They're all, lending to those merchants. How long before e-commerce? How long before food delivery, platforms, or let's say lens card platforms or anything, right? Like starts enabling lending as a feature. And for that to happen, somebody like a KUDOS is going to be super relevant, right? They don't need to go get all of the regulatory framework. They can simply plug into our network and launch like a buy now pay later product or a credit or EMI.
But Pavitra, tell me this, right? This is not a trick question, but an important question, right? Because this helps me understand your aspiration, right? As a founder, as a promoter. Now, when you of course define the 4-5 parameters that you have, right, which are very critical for you, when you're actually going out and kind of lending, empowering a lot of these institutions, right? Are you letting go of a large business, right, which could be long-term in nature, which could be more infrastructure-led, which could be asset-backed, right? Is that a conscious choice that you're making? And what do you anticipate, right? I mean, do you think at some point of time it will play into your larger scheme of things, right? Where you get into long-term loans, right? Which could be catering to a different, expectation, right?
I feel like, like if you look at like long-term games, long-term loans and everything that you're playing or asset back, I think those games are best suited to banks. It really are, right? And the reason being is that anybody who's taking a long-term loan or taking an asset-backed loan, they need like a cost of capital framework, right? But when you're looking at like say short in tenure, small in ticket size, consumer-led businesses or consumer demand, they're not very interest rate sensitive as much as like say a long tenure loan is. So you want to play like the field is very clear, right? Like those games are best suited for banks. We don't want to compete with banks. We want to disrupt like all this financial innovation that's coming out in a buy now pay later, in a card format, in a PPI format. It's a small 2-tranche disbursement EMI loan. But these are consumers and the small, these are direct to customer businesses that banks don't understand. Banks don't even know how to underwrite on alternative data. Like banks won't know like how to play a GitHub underwriting kaisa kare. Or how do I, check out YouTube number of subscribers and all. So we're very clear, right? Like this is a financial innovation platform. This is not a let's go do like asset-backed loans. There are players for that, and more power to them, right? We are very clear. We want to stay unsecured and we want to stay short in tenure. And that market is exploding.
Right. One thing that I want to understand, right? What's happening on the cost of capital, right? Well, of course, there's now a lot of data available. You're playing the game you are, right? With very clear, spends trackability, right? You're kind of ring fencing it in a certain form and way, right? How is the cost of capital shaping up, right? For somebody like you, and eventually, as you pass it on to many of these fintech players, right? Tell me a little more about that, right? Is this getting better? Is the with all of this information now available? is this relationship getting better? Are you getting better prices, or is that's still a pain point which you think needs to improve over a period of time? What's your sense of it?
So I think like there are winners and losers in both in this thing, right? So if you, and we're a vintage NBFC, we've been around for 7 years, so we have like a lot of like relationships with banks and NBFCs, and this, like I told you, when COVID happened, we took no more ads, we paid all our EMIs on time. So then again, that distinction between like, hey, what's a good NBFC, what's a bad NBFC? Is the cost of capital coming down? I mean, for the banks themselves, of course, it's coming down, right? Because RBI keeps cutting rates and all. But the transmission, could it be faster? As a borrower, I would always say that it's not happening as fast, right? And that's just the way it is. But the thing is that we don't rely necessarily only on these channels, right? We do have securitization, we do have co-lending, we run our own NCDs. So we productize our debt side as much as we can. And the way our platform works is that you can bring your capital from anywhere you want, right? It doesn't have to be a relationship of capital and tech. It can just simply be that you come from there. You can bring the capital from wherever you want. So it becomes quite versatile, right? It's optionality that if you think our cost of capital is too high for the fintechs to work with, then they can just simply get cost of capital from them. But I feel like in general, India still needs to open up, like say, external debt capital to come into the country, right? Equity is easy, but debt is not. Right. If they open that up, then perhaps like, it can act as like another catalyst for a lot of financial innovation to happen in the country.
Interesting.
Yeah. But if you're plugged into banks and you have like an existing relationship, then you are in a good place.
Is there a relationship between NBFCs and banking institutions changing, right? Because I mean, they will continue to be the largest source of capital, right? Irrespective of whatever said and done, right? But is there a change in relationship that's happening there, right? I've been speaking with a couple of fintech founders, right? They've highlighted, right, how, for example, banks have become a little more agile now, right, in terms of the entire possibility, right? And that's largely because these fintech opportunities help them explore possibilities that they never did, right? So while of course they're any bank, right, is a large ship, right, for it to sort of take a decision, go through. There are a lot of compliances, regulatory approvals that are kind of required, but at least the intent is coming in place, right? Are you experiencing the same thing? Is there a change in relationship that you see, which is coming through? What's your sense of it? What do you make out of it?
So I think like the larger question becomes that the marriage of banks and fintechs, or lending institutions and fintechs, is inevitable.
Right.
It's inevitable, and that's what like KUDOS is doing, right? Like, hey, listen, we're not trying to compete with anyone. We're just an enabling platform that allows anybody to start. Right. So, but however, on the bank's point of view, if you think about it, like it starts off as symbiotic, like maybe a bank will allow a fintech to ride on its infrastructure or give access to capital, but they're always viewing themselves as competition. Right. From the fintech's point of view, it's probably thinking that what if like I source all these customers and now the bank takes my customer and gives them like a personal loan or a saving account or a card or a credit card, whatever it could be. Right. And this has happened. There was an article by Ken, right, where a large bank terminated its relationship with two fintechs. So like this thing it's a little bit on a shaky ground right now, but like the inevitability of banks and fintechs working together, because banks' core competence is capital. I feel like they're very good at getting the CASA and getting access to capital, and fintechs are very good at like solving new problems, identifying new customer sets, going into new markets, and doing that form factor and innovation. And that's why, like, think about it, like when your banks are not, you don't use your bank app as much as you use your Google Pay and Paytm, right, to check your balance or make payments. There's a reason for that, I guess.
Super. Yeah. But what do you make out of the new models that are emerging, right? I'm a particularly a fan of revenue-based financing, right? I think that's something which is which is disrupted many other options that were available, right? And I think early days, but it's picking up, right? I've had the chance of speaking with two of the leading RBA founders, right? They've been extremely excited, extremely bullish on the possibility, right? I think a lot of things are still becoming clear. I think their underwriting models are still sort of coming together, right? Because of course, there is just so much of dynamism in the consumption trends, right? I think it'll take a little time, right? But what do you make out of this, right? You are a participant with some of these RBFs, right? What do you make out of such emerging models?
Yeah, I think like one of the beauty of from our vantage point is that we get to see so many models and the nuances in these models and how they go about it. One fintech is a little bit different from the other fintech, right? And like how they're going after the problem. And in terms of revenue-based financing, yeah, I think it's phenomenal. I think like one of the founders that you are is a very good friend, right? Like Get Vantage Bhavik, right? We power them also. So in that case, like it's a phenomenal product that is actually solving a pain point for direct to customer businesses, right? Where again, COVID was a catalyst event for them. They are one of the winners of COVID. They're not the losers, right? The traditional brick and mortar businesses lost in that one.
Right.
And then because the supporting infrastructure was also there, which is the payment gateways, or you have a lot of consumers with a lot of pent up demand with access to smartphones who want to order, and we're living in a consumerism society. These are all like, catalyst events that have like actually acted as a boom in direct to customer, platforms. And then revenue-based financing acts as a phenomenal source of capital for these D2C platforms to focus on marketing and spends, right? And they don't have to give up a piece of their equity in the bargain for this capital. And then from the lender's point of view, it's like you're underwriting not just simply from like what the business model is for the bank is, but you're looking at like the payment gateway flows, right? That the direct to customer business is actually experiencing. So you leverage that and you build an underwriting model, and then you take money, a small share every day, right? And if you really think about it, so what happens is that for the consumer brand, it's great. You get all this capital, and for the lender, it's actually cash flow trapped, right? If you really think about it, like this sort of lending was like, if you look at the offline version of this, was the POS-based lending, right? Where the guy had the card at the store, and then every day you would deduct. But the problem with that one though was that he had roughly around 20 POS machines at his Kirana store. Like if one day he could take a loan on one POS machine, but just simply start using the next POS machine, right? But in the payment gateway business, there are only 3 of them, right? 95% of the market's covered by 3 players. If you're in with the 3 payment gateways, you pretty much you can't like the cash flow is trapped. So it's a phenomenal piece of lending that is taking place, and we're like super bullish about it. It is actually one of our mainstays in our portfolio that we have over here.
Interesting. Pavitra, pay later is an option which is emerged, and how, right? I think everybody today is kind of talking about that, right? You're participating in that as a category as well. What do you make out of this? I mean, do you think we are essentially, as an economy, moving into that direction, especially in the consumer side, right? I think business is also now kind of adopting that, right? I think anywhere where there is a transaction, right? I think the comfort of being able to pay later, right? I think that just brings in, this was a very Marwadi way of doing business, right? Making a negative working capital business, right? And here it is, right? But it's now kind of institutionalized, right? What do you make out of pay later, right? Also, do you think this could lead into, with the changing demands, with that velocity, right? Are the businesses really prepared to handle this kind of a change? Could there be delinquencies higher than what we anticipate? What's your sense of it?
Yeah, I think that's a very large ecosystem question, right? And then I just want to add my 2 cents to this. If you really think about it, again, buy now pay later has been around, and then I think the first ones to actually make this was Bajaj Finance, right? When you used to go buy that TV, right? Like, and they say, hey, listen, just zero cost EMI, right? Like you take this TV and you split up that payment into 6 months or 9 months. It's been around in like in a different form, but right now, what is really unique though is that the infrastructure is caught up, right? Now with just your Aadhaar number or your PAN card, just at the POS, if I just put in that piece of information in to the system on the fly in microseconds, I am making an underwriting decision and presenting to the customer this option. And the buy now pay later works on 2 formats, right? Either it is the customer bearing the cost, right? He'll take that payment but just pay interest on it, or it's subvented by the brand itself, right? Because they just want to boost their sales. But it's such a ubiquitous and such a seamless experience for the customer. So that it, on top of it, like, again, we live in a consumerism demand society that you want to have more, you want to live more, you want to experience more things. So these factors have come into play, and it's going to be boom time for buy now pay later. I don't think this, and we were just doing research over here, and we figured out that between debit cards, credit cards, and PPI cards, credit cards are like way behind the course behind PPI cards even. And now throw into the mix of buy now, pay later, this is an exploding trend. What are the challenges associated with it? Is that in the end, this is not a payment instrument. This is a credit instrument, correct? So if it's a credit instrument, it needs to be treated with that seriousness. If I can, and if you make this credit available to, like, say, a 20-year-old or 22-year-old, what is the risk of that, right? Like, now the customer is perhaps not that credit savvy, right? And I just want to be up and relevant with my friends. So now I want to go buy that television or that phone so I can be cool in my circle. And then you create like a bad borrowing habit, right?
Absolutely.
So two things happen. One, you're creating you're possibly not creating a good credit behavior mechanism for the customer. And two is that you're probably creating a very aggressive portfolio in the name of growing business. But at the same time, this is a trend for year to stay. There will be winners, there will be losers. There's no going back from this.
But
out of the box.
Pavitra, I am kind of flabbergasted, right? Almost, right? When I look at what you're talking about, and I completely understand and buy in what you're saying, right? I think this is a behavioral shift that we are seeding in, right? But what I am worried about is the larger macros that are playing out. And as in NBFC, as a a player who's into lending, not just you, but I think many others, right, who are into the team, right? The two don't come together, right? There are those very serious struggles, right? And that's just not a national trend. That these are trends that are international. They can have a very significant, strong rub off, right? Which could mean that this behavioral shift, not supported by the larger macros, this could be a recipe for. I think disaster is going to be just too strong a word, right? But a lot of conflict, right? What do you agree with that, or you think things will kind of settle and get normal, right, as we go along? What's your sense of it?
Well, let me ask you this: like, why do you think there would be a conflict? Like, just can you elaborate on
that? No,
I
said, what I essentially mean is that the behavioral shift, right, and the macros, for example, not playing out, right? I mean, job data, if you look at it, right, people have been living off their savings, right? These are some very, very critical macroeconomic factors, data points, right? And everybody seems to be worried about it, right? And lending in an environment like that, you're essentially, so what is essentially, my thesis is that what has happened in the last 1.5 years, right? People have been exposed to content, right? With content, arbitrage between cities has gone down, right? Now you can, and you can actually buy anything and everything at a click of a button, right? So the supply chain is now kind of maxed, or kind of become so much more sharper, right? Now, with that aspiration comes a pay later kind of a product, right? Of course, there's a little bit of a science and maths which goes into it, right? But there's a certain behavioral shift which is happening, right? That I don't need to pay upfront. I can very quickly at a tap of a button buy. But what's happening is, one doesn't necessarily understands and realizes, what kind of a payout that they have to sort of make, right? And not with that clarity, right? And then you're possibly not getting your best job, you're not getting your increments, right? There's some sort of a slowdown or whatever, right? It's not moving the way it is. That just makes it so much more cumbersome. So conflict is basically coming from that thesis where my aspirations are peaking, I have possibly taken certain loans, it's not moving in the right direction. I'm getting those calls from recovery, right? Or my scores are getting bad on CIBIL or whatever, right? That's my sense of it, right? That's the thesis that I'm coming to you with. Do you think this needs to be handled a little more sharply, right?
100%, right? Like, that's why I go back to it, right? Saying that, listen, you need to be, in the end, it's a credit instrument, right? So you need to be responsible in who are you offering it to, at what terms are you offering it to, and you can't be overzealous with, like, hey, I'm just gonna like go after like the 19-year-olds and giving it to them, right? So that they can go buy Roblox or play game on Fort Magic or whatever it is, right? I don't know what kids do nowadays, but you get the drift. So there is, but like with all new things, there is challenges and then there are gifts that come with it. It now gives a very seamless experience. On the flip side, I could argue that, like, it's going to actually create credit education for somebody young. He doesn't have to wait until 25, 28 to get that credit card to understand credit. Now he can learn. So it's two sides of the coin, right? Like, but you want to make sure that this balance will continue. And there will be winners and losers. There will be like some regulatory crackdown. We say that, listen, you cannot do this. You cannot charge X. You cannot charge Y. But with all new things, it has to play its thing out. It's too early to define the rules of the game. But I think it's a wonderful product.
How I want these conversations to keep going, Pavitra, right? Because there's just so much of intelligence, right, at your end, at many founders that I speak, right? But we're towards the end of the conversation, right? Just about a few more questions, 2 or 3 more questions, right? What are some of the things that you would want at an industry level to sort of change, right? How do you what are those pieces that could solve for a better environment, right, for lending? What do you think are those, quick 2 or 3 points that you think are very important?
In all honesty, like I feel like the India framework for lending is phenomenal, because the
Right.
India stack has really come into its own, right? And we are
Right.
far ahead of the Western economies when it comes to payments, when it
Right.
comes to actually verifying a customer, when it actually comes to if you look at any market, the way it's progressing is that the payments will be the first thing to take off.
Right.
Right. Once payments takes off, you build that, you watch how that payments flows, and you build underwriting models so the lending takes off.
Right.
And if the lending takes off, investments take off. This
Sure.
is just true to any market. You go anywhere.
Right.
So payments has been able to take off because of a UPI infrastructure.
Right.
Lending's already taken off because of our India stack and its maturity. India stack needed a catalyst event, which was our COVID. So
Right.
I would say that we're on a really good track. Plus, with account aggregator coming up, OCEN coming up, the only thing that from a lender point of view, I say that access to capital needs to be more democratized.
Right.
Whether that be like international capital of debt being allowed to come in, whether that be a more friendly environment for P2P platforms to flourish, right? So all of this will give access to capital to lenders that can in turn lend through fintechs, which in turn the end customer will benefit. There's no point if the banks keep borrowing at 3%, but keep the market rate for borrowing in the market is like at 15%.
Right.
And then banks don't even have enough ways to give that money out. They give it back to RBI.
Right.
So, the number one pain point I would say is that all the supply of capital needs to find a way to where it's actually required. Because unfortunately, the ones who need it the most pay for it the most.
Right.
So you want to solve that. You want to be able to solve that.
Interesting. Pavitra, my last question for the day today, for our session right here. What are the next 2 years like, right? You've been at it. You've seen this change happen, right? You've seen this shift happen. I think the model has become much sharper, right? What are the next 2 years? I would love to ask you a 5-year question, right? But I think we're at a different time, right? Time zone.
Yeah.
I think that'll not be the right question, right? But what are the next 2 years like, right? What are the priorities?
So we've done just some markers, right? In terms of so we've done 2,500 crores worth of disbursement. We want to head up to $1 billion worth of disbursement within the next 2 years. And though at the pace at which the finance fintechs are getting launched, or tech marketplaces are enabling lending as a feature, I think KUDOS is sitting at a phenomenal position to leverage off that, right? And we will keep expanding our capabilities from actually launching on top of your lending. If you want to launch a insurance product, if you want to launch a PPI license card, the form factor is a card, or it is a virtual card, or it's a QR code based UPI payment, KUDOS will be ubiquitous. If you think about podcasts and fintech, we think Asia Tech Journal. We're going to think like fintechs and lending. You're going to think KUDOS, right? That's what's going to happen in the next 2 years, and we're well suited for that. We're super confident that we're going to go get it.
Super. Pavitra, this is a parting question, right? I think every founder has a unique journey, right? There's a lot of learning, right? Which I think each founder has. And I think it's not right. I think in the interest of the ecosystem to let go of you without asking you, what will that advice or suggestion be, right? I think it's a difficult journey, right? I think when you're starting out, it's a difficult journey. It's a journey where you understand a lot about yourself, right? You explore yourself in a very different way. There are doubts, right, that you need to sort of tackle, and then there are people who are disbelievers, right, and you need to sort of still navigate through those waters. And it's a difficult path, right, that a founder has to take. What will that suggestion advice be, right, that you would want to give out to people who are building up, right, in a market like India, which is exciting yet complicated? How to stay focused, right? I'd love to hear from you that one.
Wow. I was off all the cliche advice. You already said them, but I think that, I think it's such a personal journey, but the number one thing, I think startups, 90% of the startups fail because, and only 10% make it because probably 90% of the founders give up. Right. I think the number one thing is resilience. You don't need anybody. What's that? There's a famous quote, right? Startups don't die when startups die when founders run out of energy.
Right.
When they themselves cannot go on anymore, or they don't believe it anymore because they've heard too many no's, or they've had too many disappointments. And that's what usually leads to the death. It's not the real product market fit or something. Because if it's not a product market fit in that one, then you can shift, right? In just our journey itself, we've almost become 3 companies in 7 years. Right. And then the pace of evolution demands that. So resilience and grit, I would say, and the belief, right? And like you rightly pointed out, this is a journey of self-discovery,
Right.
like who you really are and what you really, if you can thrive in chaotic situations, this is it for you. Sign this up, and a lot of people can't. So, but if you can, this is it for you.
Last one, right? This wasn't, it just came to me. I had completely missed out on this fact, right? You largely stayed, bootstrapped, right? You've largely stayed profitable, right? The choice of being bootstrapped, the choice of being profitable, right? Any comments on that one?
Yeah, I think like I just didn't wrap my head around that. Why would a business need to make a loss to begin with? That was one thing for us. And then the second thing is like, hey, we should go raise some money. But
Right.
the truth of the matter is that we couldn't raise money, right? Like when we first started that journey. Then we were saying like, you know what, it doesn't matter, right? Like, hey, if we're going to do it, if we are really a company that is actually solving a problem, then we'll have paying customers.
Right.
And those customers are far better than any investors, because it leaves you in a position that if you ever raise capital, you should raise capital because you want it,
Right.
not because you need it. There's a
Right.
fundamental difference between these two statements, right?
Right.
So the lack of, say, external capital, like coming in at a large scale, meant that we became ruthless with execution,
Right.
Supremely resourceful, and very nimble in actually identifying the opportunity and building a business.
Right.
So 5 years, 5-7 years later, we still own majority of the company. Of course, we have some phenomenal fintech founders that have backed our vision, right?
Right.
We have Nishal Shetty of Azirex, Nitin Kamath of Zerodha, Sumit Manyar of Rupeek. We have Anisha Chutan of Open Banking. So we're like super proud to have them on board and back our vision as to what we've done. And then there's Web of a Better Capital also.
Right.
But the decision to be profitable, I think like once you do it for so long, or not to make profits, right? And now we're a product market fit company. So even if we do raise money, the way we see it is our profits will only rise. It won't be like less profits. So it's been a phenomenal journey. And I recommend that you don't have to raise money like right off the bat. Some businesses may just require, and that's just the way it is. But try to build it as much as you can. And then when you want it, not when you need it, then you take that external capital.
On that note, Pavitra, this was an absolutely phenomenal conversation, right? I loved every bit of it. I love the energy of the conversation. Thank you so much for being candid and extremely honest, right? I think you've pretty much given away everything, right? And I think there's just so much to learn from, right? Implicit and explicit, right? In this conversation. Thank you so much, right? Loved, like I said, every bit of the conversation. I look forward to having you with us much sooner. I think what I would love to delve with you on our finer nuances, right, of the lending business, right? Because this, I think we're in a very, very dynamic time. We're in very, very interesting times, right? I think our country is changing every single day. Our aspiration is speaking, right? We haven't seen, we were never there, right? We're at a very different time zone. And I think that's it becomes important to have you and discuss those finer nuances, right? So look forward to having you with us much sooner. Thank you so much for taking the time out, and loved every bit of the conversation.
Hey, thank you, Ashu. I really enjoy your energy too, and the way you host these podcasts, and I wish you all the best. I know it's going to be a phenomenal channel going forward, and I look forward to coming back.
Thanks, Pavitra. Thank you.
All right.
Bye.
Thank you. Bye.